So this week we bought Pegasystems, ticker PEGA, and disclosure first, as always. We own it, bought with our own money, so nothing here is neutral. Now watch this line, because it's the whole reason we're interested. Public in 1996 at about $4, crushed to just over $1 in the dot-com bust, then a 20-year grind to $69 in 2021. And since then, cut in half. This company has been left for dead twice before, and both times the business kept going. That's the setup. What does it do? Pega makes the software big organizations use to automate their heaviest paperwork. Insurance claims, customer onboarding, government casework, boring, deep plumbing that's painful to rip out. It was founded in 1983. The founder still runs it. And today, it's a $5.5 billion company. So why is it down by half? Their own filing says it plainly, and we respect that. Unprecedented changes in the AI market caused clients to delay purchasing decisions. Growth in annual contracts slowed to 7%, and they warn the delays may continue this year. Companies aren't sure what software to commit to while AI shakes out. That's the fear from the company itself. Meanwhile, the cash side just set a record. Over $285 million of free cash in the first half of the year alone. And look at our page. Pega now keeps about 28 cents of every dollar of sales as free cash, up from 23 last year. Whatever clients are delaying, the existing business is throwing off more cash than ever. Our buy zone reads strong buy with caution, and this one comes with a note worth hearing. The price sits about 21% below its own 200-day average. This read is marked high reliability because past buy signals here went on to beat the market by about 10% a year. But there have only been 3 of them. 3 is a pattern, not a law. And the price tag is the striking part. You're paying about $17 for every dollar a year of profit, and about $14 on next year's expected earnings. Similar application software companies go for about $31. That's roughly half the going rate for a business with a record cash half behind it. And recently, buying has started to build. Our trend reads plus 35, with 13 of the last 20 days closing strong. Same honest caveat as always, though. That's happening on volume about 28% lighter than the weeks before. Quiet accumulation, not a rush. The health row holds up too. Operational score 7 out of 9, strong. Bankruptcy risk, safe, with room to spare. Earnings quality, clean. And it's beaten expectations in 6 of its last 8 quarters. This isn't a broken company, it's a doubted one. Now the risks out loud. First, the company itself says the delays may continue for the rest of the year, and we take them at their word. Second, one of our own valuation reads pushes back, measured against cash profit including debt. Pega isn't so inexpensive. That red flags it as rich. And third, our sector chip says money is rotating out of this corner of the market right now. We bought it with all 3 on the screen. So that's the bet. A 30-year survivor, run by its founder, throwing off record cash, priced at roughly half its industry's going rate because clients are pausing while AI shakes out. If that spending settles into tools like Pega's, the cash keeps compounding and today's price will look like the opportunity. If clients keep delaying, growth stays slow and we're early, or wrong. We own it as of this week. That's what we did and why. Visit us at smartcharts.co, where we explain the stock market in plain English for people who were never given the manual. Nothing here is financial advice.